Good morning. It's Traderfirstyear. I'm experimenting here with a new format and adding just a little bit of voice to the morning forecast and seeing if that actually maybe generates some more views and gives the people a little bit more clarity. So this is the 2/17/2021 morning forecast. Markets are implying a move of 1.33% plus minus up down. On the S&P 500. Markets have realized a move of 1% plus minus up down. The difference between what market makers are implying and what has been realized has considerably tightened. The spread narrowed to 5 basis points. The put-call gamma imbalance is skewed towards short-dated calls on dip buying. However, a tighter spread leaves some left tail risk and mitigates vol upside. Realized volatility has stabilized around 16. S&P is expected to move close to 1.27% up and down this week, which means the S&P is likely to remain 13 to 15% above its 200-day moving average, which is 3,402. Weather disturbances due to the Arctic air polar vortex weighing on the Midwest and southern states will negatively impact growth in Q1 2021. Weak non-farm payrolls, along with slowing growth in real GDP in the fourth quarter, are key economic indicators likely to pressure growth in the first half of 2021. However, a finalized fiscal deficit package of 1.9 trillion via reconciliation in Q1 2021 is expected, which is significant tailwind to nominal growth in the second half of 2021 and first half of 2022. This assumes virus cases come down and pandemic flare-ups lessen. Large fiscal savings increases capital inflows to finance very large twin deficits, which should put upward pressure on the US dollar and downward pressure on corporate and government bond yields. Dollar appreciation dampens inflation and should lead to temporary transitory base effects. Inflationistas and inflation fearmongers engaging in scare tactics are likely to be proven wrong. However, there is some base effect short-term transitory spikes in inflation data from February, March, April, and May. Market expectations are split, but I expect the Federal Reserve will look through these spikes. Political risk has diminished in the first quarter due to reconciliation, but it has increased in the second half of 2021 and first half of 2022, which may pose risks to much needed investment spending in infrastructure, human capital, and research and development. So I view it in the medium term as tilted to the upside due to political gridlock. Following this weekend's congressional failure to hold public officials accountable, increases lone wolf domestic terrorist attacks from an elevated level. But this sign of weakness increases foreign terrorism risk. In my humble opinion, it endangers all 330 million Americans, regardless of political affiliation. Negative labor data fosters a rise in economic uncertainty. Vaccine distribution priced into Q3 2021, but distribution obstacles have increased and efficacy for herd immunity will be closely watched. Details are currently unknown. The market is currently pricing in an additional 4% move plus or minus up down by March 19th, 2021. The S&P could potentially trade as high as 4,084 spot 08 and as low as 3,775 spot 61 by March 19th. The VIX is expected to move 7.84% or points. The VIX is currently 2128. The VIX price range is 2294 to 1973. The skew index is extremely elevated, which indicates market participants are paying up for catastrophic protection, 2 sigma events. Stocks continue to offer investors the highest real returns. The nominal yields on equities is 4.5%, while the nominal yield on 10-year treasuries is 1.3%. Real yields on all tenors of government bonds are decisively negative, while real yields on U.S. equity positions are positive. Disclaimer: with realized volatility rising above 12, there is a larger risk of systematic, highly levered short vol strategies like equity vol targeting, trend following, and risk parity starting to sell off and reduce market exposure. So a much larger delayed sell-off of 4 to 5% is coming. GameStop naked short sellers have significantly harmed the proper functioning of equity markets in the short term. The GameStop crisis seems to have been reduced, and there are early indicators a large segment have covered their naked short positions, which is reducing the astronomical rise in the share value. Stabilizing failed to deliver shares on the New York Stock Exchange, which is leading to substantial buy-in on stock loan desk, which is lessening spillover effects on smaller brokerages and broker-dealers forced to cover like Robinhood. This is harming the underlying plumbing of the financial markets and may force some brokers off DTC, which is Depository Trust Corporation, if they are unable to fulfill their requirements. The Feb March VIX contracts at 27 and 28 are still underpriced. They should price near 39 to 47 in my humble opinion. I strongly believe February 2021 could replicate February 2018, although midway through the month, those signs are diminishing and looking less likely.